The vault door is already closed. The obligation inside it has no exit date. It simply waits. The debt existed before the meeting. It will exist after the meeting. The meeting is not about the debt. In 1972, the borrowing was described as temporary. Temporary had no fixed definition. No one asked for one. Dollars moved north through wire transfer. Infrastructure. The infrastructure did not record what was owed in return. The interest rate was fixed at signing. The world rate was not. The difference accumulated silently. Central bank reserves were measured quarterly. The short-term obligations matured monthly. The interval was structural. The rollover was processed as routine. The mechanism did not distinguish routine from postponement. It processed both the same way. The creditor bank recorded the transaction as an asset. The debtor bank recorded it as liquidity. Neither recorded it as risk. Oil revenues entered the system in 1973. The system was not designed to hold that volume. It redirected the excess outward. Petrodollars pooled in northern institutions. The institutions needed somewhere to put them. Latin America had a use for them. The loan terms were competitive in 1974. Competitive meant acceptable. Acceptable meant signed. Signed meant irreversible. Capital moved through correspondent banking channels. Each channel added one layer of distance between origin and obligation. The sovereign guarantee was considered sufficient. Sufficient meant no further review was required. No further review was conducted. The first rollover occurred in 1975. It was described as a refinancing. Refinancing required no new approval. The cycle began. The obligation grew not through new borrowing alone. It grew through the mathematics of compounding at a floating rate. Both were silent. The Federal Reserve began raising rates in 1977. The decision was domestic. The consequence was not contained to one country. Floating rate debt repriced automatically. No negotiation was required. The repricing happened while the borrower was occupied with other obligations. Each successive rollover carried the previous one inside it. The structure was not visible from outside. It was visible only in sequence. The International Monetary Fund observed the pattern. Observation was within its mandate. Intervention was not yet requested. The external debt-to-export ratio was a known metric. It was known. The threshold was also known. Both numbers were available simultaneously. Export commodity prices declined through 1977 and 1978. The debt service obligation did not decline with them. The gap widened without announcement. The central bank issued assurances. Assurances required no underlying collateral. The assurance was the instrument. The creditor syndicate renewed the facility. Renewal was presented as confidence. Confidence was indistinguishable from necessity. The interbank market priced new debt higher each quarter. Higher prices did not stop the borrowing. They became part of the next rollover. The borrowing nations held elections. Governments changed. The debt did not change with the government. It transferred automatically. New finance ministers received the same briefing. The briefing described the position accurately. It did not describe a solution. No solution existed in the briefing. In 1979, the Volcker rate adjustment began. The floating rate on existing debt moved upward in a single mechanical motion. It did not pause for review. Debt service costs doubled for several nations within 18 months. Doubling was arithmetic. It required no decision to occur. Foreign exchange reserves declined as service payments were made. Each payment was legitimate. Each left less behind than the one before. The creditor banks continued lending. Continued lending prevented an immediate default. Prevention of default was indistinguishable from deepening exposure. The rollover of 1980 was the largest to date. Largest had no ceiling in the mechanism. The mechanism did not include a ceiling. Austerity programs were proposed as a condition of continued lending. Proposed did not mean implemented. Implementation was deferred to the next cycle. The pattern was documented by the Bank for International Settlements. Documentation is not intervention. The two have never been the same action. Those who tracked these systems closely found that the record was always accurate. Accuracy did not produce change. It produced more record. By 1981, the total regional debt had reached a scale that made individual country default a systemic event. Scale changed the nature of the problem. It did not change the mechanism. Mexico held the largest single position. Largest did not mean most exposed. It meant most visible when visibility became unavoidable. In August 1982, the Mexican government communicated that it could not service the debt. Communication arrived on a Thursday. The system had no protocol for a Thursday communication of this kind. Emergency coordination began between northern central banks and the IMF. The coordination was real. What it confirmed was also real. The cycle had reached its terminal point. Brazil, Argentina, and Venezuela each carried equivalent structural exposure. The mechanism had not distinguished between them. It had treated them identically. The IMF intervention required acceptance of structural adjustment. Acceptance was the condition of the next disbursement. The next disbursement was already scheduled. Adjustment programs compressed public expenditure. Compression was measurable. Its effects were distributed across the population invisibly. The debt was rescheduled rather than restructured. Rescheduling preserved the principal. It also preserved every obligation attached to the principal. Secondary market prices for the debt fell through 1983. Falling prices were a market signal. The signal was observed. It was not acted upon institutionally. Commercial banks began provisioning against the debt quietly. Provisioning was a private acknowledgement. The public position remained unchanged. The decade that followed was called the lost decade in economic literature. Lost implies misplacement. The decade was not misplaced. It was consumed by the service of obligations already incurred. Development budgets were redirected toward debt service year after year. Redirection was presented as fiscal discipline. Discipline and redirection described the same transfer. The Brady Plan of 1989 introduced debt relief through bond conversion. Conversion acknowledged the problem. It did not eliminate the principal. It restructured access to the principal. The institutions that issued the original loans continued operating. They reported losses. They absorbed them. None was required to account for the mechanism that produced them. The mechanism was studied extensively after 1982. Studies produced recommendations. Recommendations entered the procedural literature. The procedural literature did not change the next instrument. The rollover cycle returned in modified form in the 1990s. Modified means the surface changed. The underlying structure of short-term obligation did not change. The mechanism does not require crisis to continue. It requires only that the next maturity date arrive. The next maturity date always arrives. The obligation transferred across generations of officials, institutions, and governments. Transfer was not visible in any single transaction. It was visible only in accumulation. The system did not fail because of a single decision. It continued because of many decisions that each appeared individually reasonable. Collectively, they were not. The vault at the beginning of this account is still in operation. Its contents have changed. Its function has not. The obligation it holds was placed there by a mechanism still in use. The rollover was not an accident. It was a procedure. Procedures do not stop themselves. They stop only when something outside them refuses to continue.